India on Friday recorded the highest one-day surge in COVID-19 cases, with 6,088 infections being reported in past 24 hours. The country now has 118,447 coronavirus cases overall, according to the Health Ministry data released on Friday morning. Amidst such a scenario, the Reserve Bank of India today slashed its key policy rates to stabilize the financial system and tackle the economic fallout from the ongoing nationwide lockdown to contain the spread of coronavirus pandemic. Addressing the third press conference in last 2 months, RBI Governor Shaktikanta Das announced the panel's decision to cut the repo rate by 40 basis points to 4% and the reverse repo rate by 40 basis points to 3.35%. So it means that the rate cut will make funds cheaper for banks, thus helping them to bring down lending rates. This in turn, which leads to cut in 40 basis points in reverse repo, the interest rate the RBI offers to banks for funds parked with the central bank, will prompt banks to make available funds for productive sectors of the economy. Similarly, in another significant move, the country's central bank has also announced extension of moratorium on loan repayments by another 3 months to August 31. This will help borrowers, especially corporate sectors, which are facing cash flow issues and have halted production, to get more time to stabilize their operations and restart their units. All borrowers, including home loan, term loans and credit card outstandings, will get the benefit of the extension of moratorium. With the COVID crisis not seeming to ease soon enough, the RBI governor has also said the overall country's growth is likely to be in the negative territory in 2020 and 2021. RBI has clarified that even though the lockdown may be lifted by end May with some restrictions, economic activity even in second quarter may remain subdued due to social distancing measures and the temporary shortage of labor. Recovery in economic activity is expected to begin in third quarter and gain momentum fourth quarter as supply lines get gradually restored to normalcy and demand gradually revives. Some other key pointers rolled out by the RBI in today's briefing include: agriculture sector has offered a ray of hope. It is because of the forecast of normal monsoon. Another good news amid the COVID crisis is that even though the headline inflation may remain firm in the first half of the year, it is expected to fall in Q3 and Q4 below target of 4%. India's foreign exchange reserves have increased by 9.2 billion during 2020-21 from 1st April onwards. The reverse stands at $487 billion as of May 15. Domestic demand has collapsed, economic activity severely affected due to 2-month lockdown. Industrial production shrank by close to 17% in March, with manufacturing activity down by 21%. Since RBI assured it would do anything to keep the economy going as expected, the regulatory decisions taken in March and April were rolled over since there was a massive and negative impact on business enterprises. The central bank has not opted for any new route of liquidity provision, which was expected post the FM's announcements last week and would have helped sectors like aviation, hotels, tourism, entertainment, auto, etc. In fact, these are the sectors that have seen a setback due to the lockdown. Since all these decisions will have a major impact on banks, they may even be rethinking of reworking their business models. It's important to see the impact of these RBI decisions on Indian shares that fell on Friday. While it is said that RBI's announcements are a major booster shot for the COVID-hit economy of the country, it remains to be seen how the new policy decisions will have a further impact.